Regular viewers of my channel know that I talk a lot about real estate investing all the time. There are many reasons why this is the case. Real estate investing helps you generate cash flow. It helps you hedge against inflation. Properties tend to go up in value over time, and you get depreciation. When used correctly, real estate investing also tends to generate the best tax savings. In fact, there are several loopholes in the tax code that will allow you to use real estate losses to offset W-2 or 1099 income. What this means is that if you are someone who works a job or who has a business, then you can use one of these loopholes to take losses that you incur from your real estate investing activity to claim them as deductions against your primary source of income. In other words, under certain circumstances, real estate investors get to deduct rental losses, not only from their real estate investing income, but also from their other sources of income, such as their primary jobs. There are two ways that you can do this if you're a real estate investor. The first is through short-term rentals. If the average stay at your rental property is 7 days or less, then the IRS allows you to offset your active income as long as you're materially participating in your rental. This makes having an Airbnb one of the best ways to save money on taxes. I have many videos explaining this topic in greater detail, so feel free to go check those out. But one of the ways that you can use losses from real estate investing to offset your W-2 or 1099 income is by qualifying as a real estate professional. I get asked all the time, Karlton, what is the real estate professional status? Real estate professional status, which is referred to as REPS for short, is a special status that only certain people who are substantially engaged in rental properties or trades can hold. REPS is an official designation acknowledged by the IRS, and in order to qualify for REPS, you have to meet strict requirements. The requirements for achieving real estate professional status or REPS are: 1, more than 50% of your personal service time or working time in the world must be dedicated to a real property trade or business. And number 2, you must actively participate at least 750 hours of service with real property trades or businesses per year, and you gotta materially participate. There are many different real property trades and businesses that the IRS allows you to participate in to achieve real estate professional status. There's 11 of them: development, redevelopment, construction, reconstruction, acquisition, conversion, rental, operation, management, leasing, and brokering. So if you're someone who works in one of these real property trades for more than 750 hours per year, if more than your personal service time is dedicated to one of them, and if you materially participate, congratulations, you can qualify for real estate professional status. What this means to you is that you can use your real estate losses to offset your W-2 or your 1099 income. But here's the problem with real estate professional status. Real estate professional status is great for people who can qualify for it. However, the problem with it is that it's really difficult to achieve it if you happen to have a job or a business in a field that is not related to real estate. So for example, if you're a lawyer, if you're a doctor, if you're a nurse or engineer, and you want to capitalize on all the tax benefits of real estate investing, it is going to be almost impossible for you to qualify for real estate professional status. In fact, you would probably have to work for about an extra 40 to 50 hours per week in your real property trader business on top of your normal W-2 job or business in order to have that requirement of more than 50% of your personal service time dedicated to a real property trader business. So unless you're comfortable working 80 to 90 hours a week, then it's going to be extremely difficult for you to qualify as a real estate professional if you have a full-time W-2 job or 1099 business. This is where having a spouse can be extremely beneficial. Spouses and real estate professional status go together like Chris Tucker and Jackie Chan. Even though it is difficult for many professionals who work outside of the real estate industry to qualify for real estate professional status, many of these people have spouses. And the amazing thing about having a spouse is that if you're married and if you file jointly, then your spouse can actually qualify as a real estate professional, which can enable the both of you to use rental losses to offset your W-2 or 1099 income. So if you're someone who wants to invest heavily into real estate for tax benefits and other benefits, but you can't meet the qualifications for real estate professional status and you don't want to run a short-term rental business, then you might still be able to have real estate professional status as a couple if your spouse can qualify. Let me give you an example so you can better understand how this incredible tax strategy can really work in your life. Steve is a dentist from Arizona who makes $225,000 per year. He's married and has 2 children. His wife Susan works part-time as a paraprofessional at a local elementary school. Steve and his wife decide that they wanted to invest in a rental property in order to generate some additional income to help them build a bigger nest egg for retirement and to save for their children's college education. Through some research, Steve and Susan learned that people who qualify for real estate professional status can use rental real estate losses such as depreciation to create a tax deduction that can offset W-2 income. They were very excited to learn about this, but Steve knew that he would not be able to quit his 9-to-5 job as a dentist just to qualify as a real estate professional. So they decided to have Susan become the real estate professional instead. Susan started investing large quantities of time in their new real estate business. She researched all of the properties, she performed the market analysis, she spoke to the realtors, contractors, lenders, and eventually led the process to buy a 5-unit apartment building in Arizona. Now Susan's responsible for managing this property. She manages the maintenance issues, handles the collection of rent, the leasing of the property, and otherwise materially participates for the rental operation. Because Susan is so heavily involved in the rental real estate business that she and her husband both own, she is able to qualify as a real estate professional if she can work more than 750 hours in the business and spend more than half of her personal service hours dedicated to real estate. If she can show the IRS that she materially participates and spends more time in this business than her part-time job, Steve and Susan can file their joint tax returns together, which means that even though Susan does the work to qualify for real estate professional status, they both get to qualify as real estate professionals as a couple for tax purposes. For their combined non-rental income, Steve and Susan make up $265,000. But because Susan qualifies as a real estate professional on behalf of them both, they were able to use $80,000 of rental losses on their 5-unit property as a tax deduction. This reduced their taxable income for their jobs by roughly 30%, which resulted in massive tax savings. Now Steve and Susan have tens of thousands of extra dollars per year to put towards their children's college education funds. They also are very happy to know that as a result of this strategy, they plan to buy more rentals in the future. Susan also plans to quit her job as a paraprofessional so that she can focus entirely on growing the real estate business for the both of them. Here's the bottom line. When it comes to real estate professional status and spouses, is that if you do not have enough time to become a real estate professional yourself, but your spouse does, then you can make your spouse your real estate professional so you both can qualify for the additional tax benefits of real estate professional status together. Many of my clients use this exact strategy to save tens of even hundreds of thousands of dollars in taxes every single year. If you want to learn more about this strategy, then get in touch with my tax team by clicking on the link below in the description. We have helped hundreds, if not thousands at this point, turn their spouses into real estate professionals or do accelerated depreciation to create a loss on the return. Now, let's move on to a question that came from one of my subscribers on my channel. He asked me a question about real estate tax benefits. Subscriber Jose Leandro asked, can I use depreciation on a property that has been bought through seller financing? The answer is yes. If you have purchased a property through seller financing, you're the one that's on title, so you get to claim depreciation. This is one of the many ways that real estate investors have gotten around the high interest rates to still be able to buy real estate and in return accelerate depreciation. Now, if you guys have been watching my channel, you know that I teach about tax strategy quite heavily on here, but there's so much more to learn. And if you're interested in learning more from me, go ahead and smash the subscribe button, like this video, and comment underneath this video to help grow this channel. Our goal of getting to 1 million subscribers is very close and within distance, and you can help us get there. Thank you so much for watching this video. You guys know what to do. Like, comment, subscribe. I'll see you guys on the next video. Cheers.